For most of us, building wealth follows a predictable rhythm. You buy low-cost index funds, maybe mix in some bonds to hit that classic 60-40 split, and then you just wait. It's a reliable playbook that works perfectly for standard retirement accounts. But when a portfolio hits 10 figures, the physics of that playbook completely shatter. At $10 billion, normal market rules break down. If you attempt to execute standard retail maneuvers at this scale, your own capital becomes a gravitational force that distorts the assets you are trying to buy or sell. In the mid-90s, Bill Gates owned roughly 24% of Microsoft's outstanding shares. This meant his entire net worth was locked inside the walls of a single corporate empire. He couldn't just log into a brokerage and sell $1 billion of stock to diversify. Moving that volume of shares on the open market would instantly crater the stock price, triggering mass panic among regular shareholders. To solve this, Billionaires build the family office. This is a highly secretive private investment firm created with one singular mandate: to manage, protect, and multiply the wealth of a single family without alerting the broader public. Navigating wealth at this altitude requires engineering an entirely new set of financial mechanisms. You have to build custom infrastructure just to keep your own capital from crushing you. Look at Bill Gates' Cascade Investment firm, or Michael Dell's massive MSD Capital. These family offices diffuse the extreme concentration risk of their founders. This chart shows a strategy called programmatic divestment. Instead of trying to guess market peaks, these offices sell a fixed number of shares on a rigid, predetermined schedule. Over decades, this staircase pattern slowly drains the concentrated wealth out of the founder's company. From there, the family office redirects that extracted cash, pouring it into hard inflation-protected assets. Over 30 years, Gates traded Microsoft shares for heavy industry. Cascade acquired massive stakes in North American rail lines, like Canadian National, like Burlington Northern, and vast U.S. farmland. For the mega-wealthy tech founder, true preservation means exchanging the software that made them rich for the bedrock physical infrastructure that runs the economy. While tech founders sell out to diversify, Warren Buffett eventually hit what is known as the scale wall. This is the exact moment an investment portfolio becomes too massive to execute its original, highly successful playbook. In his early partnership era, Buffett aggressively hunted for struggling microcap businesses. He would buy them for less than their liquidation value, force management changes, and sell them for a profit. But you cannot deploy hundreds of billions of dollars into tiny, illiquid companies. To survive his own growth, Buffett had to shift entirely to acquiring mega-cap companies with durable economic moats, businesses with enough pricing power to absorb massive amounts of capital. Today, he operates with near total passivity. He takes the continuous streams of cash generated by Berkshire's insurance premiums, uses it to buy premium companies, and simply leaves their existing management alone to compound that cash over decades. Warren Buffett achieved permanent scale by redesigning his entire capital machine to operate completely independently of his day-to-day oversight. On the opposite end of the spectrum, you have the Duquesne family office, managed by Stan Druckenmiller. His system completely rejects the idea of holding anything forever. Druckenmiller operates as a macro-agilist. He tracks global liquidity cycles and central bank policy shifts and uses that data to rapidly move billions of dollars across public equities, fixed income, and commodities as conditions change. This strategy requires extreme speed. He limits his equity positions to highly liquid mid to large cap stocks, like his massive holding in the medical testing firm Natera, ensuring he can enter and exit multi-million-dollar positions without friction slowing him down. Then there is the founder-investor archetype, best illustrated by Jeff Bezos and his family office, Bezos Expeditions. Bezos ignores traditional risk management. Instead of spreading his capital thinly, he makes highly concentrated, conviction-driven bets on orbital infrastructure and platform businesses that require decades to mature. He turned a $250,000 angel investment in Google into roughly $3 billion and currently dumps tens of billions into advanced biotech, robotics, and commercial aerospace. At this altitude of wealth, alpha comes from two extremes, either possessing the agility to outmaneuver the global market or holding the capital buffer required to wait longer than anyone else. Ray Dalio and Bridgewater Associates tackled the billionaire's dilemma from a purely mathematical angle, creating the all-weather portfolio. Their core premise is simple but radical. Trying to predict the future is a trap. Since nobody can consistently time the market, your portfolio shouldn't require you to guess right. This matrix visualizes the concept of risk parity. Instead of dividing dollar amounts, Dalio balances actual risk across 4 economic environments: growth, inflation, deflation, and recession. By carefully weighting volatile stocks, long bonds, and commodities, one quadrant covers the losses of another. Dalio's math proves that true preservation relies on pairing assets that react in exact opposite ways to the identical economic weather: active trading versus passive holding, extreme concentration versus total parity. These strategies are entirely contradictory, yet they have all generated staggering wealth. But if a standard retail investor simply copies these portfolios ticker for ticker, they will fail. They don't have the institutional scale, the complex tax deferral mechanisms, or the sheer cash buffer needed to absorb the friction of these maneuvers. The common thread across these playbooks is strategic alignment. Success requires selecting a single philosophy, whether it's hunting for moats like Buffett or hedging risk like Dalio, and ensuring it flawlessly matches the actual size of your capital. The ultra-wealthy don't rely on secret stock picks. They build a mathematically cold, customized system that allows their capital to compound over decades, entirely insulated from human panic.